Corporate promises made to a workforce are often future-dated and subject to long-term uncertainty. The challenge is translating those human capital agreements into precise, present-day financial liabilities that are locked into the balance sheet. That translation is governed by International Accounting Standard 19. It covers all employee benefits, from rank-and-file staff up to directors and management personnel. The single strict exception is share-based payments, which fall entirely under the jurisdiction of IFRS 2. The standard operates on a single core axiom. An entity must recognize a liability when an employee provides service in exchange for future benefits, and it must recognize an expense when the entity consumes the economic benefit arising from that service. As this diagram of the IAS 19 objective shows, the exact timing of cash leaving the business is irrelevant to the recognition of these obligations. The liability accrues exactly when the work is performed. The standard categorizes these obligations chronologically. Short-term employee benefits are classified by a strict threshold. They are benefits expected to be settled wholly before 12 months after the end of the annual reporting period in which the service is rendered. By separating the obligation from the eventual cash payout, IAS 19 overrides simple cash basis assumptions. It requires companies to recognize the financial weight of their workforce as that workforce is utilized. Short-term employee benefits carry a unique accounting treatment. Because they are settled so quickly, they are recognized at their undiscounted amounts, allowing entities to bypass complex present value discounting. Within this category, paid absences are bifurcated into two types: accumulating and non-accumulating. Accumulating absences can be carried forward, and they may be vesting, meaning cash is paid for unused time upon departure, or non-vesting, where the time simply expires. We can see how accumulating, non-vesting absences are measured using this sick leave chart. An entity has 100 employees, each granted 5 days of sick leave, tracked on a last-in, first-out basis. The liability is measured based on expected utilization, not theoretical maximums. Looking at the data, the entity expects 92 employees to take no more than their standard 5 days, meaning they use 0 carryover. The remaining 8 employees are expected to take an average of 6.5 days each. That means only those 8 employees will dip into their accumulated allowance, using 1.5 extra days apiece. 8 employees multiplied by 1.5 extra days. The specific resulting liability recognized on the balance sheet is exactly 12 days of expected payout. A similar rigor applies to profit sharing and bonus plans. These are recognized if and only if the entity has a present legal or constructive obligation to make the payments, and a reliable estimate of the obligation can be made. Take a profit sharing plan requiring a 3% payout of total profit to employees who remain for the full year. If staff turnover estimates indicate some employees will leave before vesting, that 3% target drops. If the reliable estimate lands at 2.5%, the entity recognizes a liability and an expense of exactly 2.5%. Under IAS 19, an obligation under a profit-sharing plan results from employee service, not from a transaction with owners. These distributions are classified strictly as expenses, never as distributions of ownership profit. As we move past the 12-month threshold into post-employment benefits, the standard's complexity scales to account for long-term economic uncertainty. Post-employment plans are divided by where financial risk ultimately lands. The first classification is the defined contribution, or DC plan. Here, the entity's legal or constructive obligation is strictly capped at the fixed amount it agrees to contribute to a separate fund. This animation isolates the consequence of a DC plan. Because the employer's commitment ends at the contribution, both the actuarial risk that benefits will be less than expected and the investment risk that assets will underperform fall in substance on the employee. A defined benefit, or DB plan, is classified as any plan other than a defined contribution plan. Under a DB plan, the entity is obligated to provide the agreed future benefits. This shifts the actuarial and investment risk to the employer. There are strict rules for edge cases. Multi-employer and state plans must be treated as defined benefit plans if sufficient information is available. If identifying a reliable proportionate share of the obligation is impossible, only then can the entity revert to DC accounting. Even when an entity pays insurance premiums to fund a plan, it only qualifies as a DC plan if the entity retains zero direct or indirect obligation to pay further amounts should the insurer default. This risk classification dictates the entire accounting architecture for the plan. DC plans allow for simple, undiscounted accrual matching the contribution period. DB plans mandate continuous actuarial modeling to track the volatile, long-term obligation. Accounting for defined benefit plans is a four-step process. Determine the deficit or surplus, adjust for the asset ceiling, determine the amounts for profit or loss, and finally, determine the remeasurements for other comprehensive income. Step 1 relies on a mandatory actuarial technique to measure the total DB obligation. It is called the projected unit credit method. To see how this works, we can look at this 5-year ledger. The projected unit credit method views each period of service as giving rise to an additional unit of benefit entitlement, building up the final obligation unit by unit over time. We establish our baseline variables. An employee starts at a salary of 10,000 currency units. We factor in an expected 7% compounding annual salary increase and discount the obligation back using a 10% rate. In year 1, that creates a current service cost of 131 currency units. As the years advance, the math compounds. The opening obligation from the prior year adds the new interest cost, plus the new current service cost for that specific year, generating the closing obligation. By year 5, the total obligation reaches 655 currency units. If a plan's formula backloads benefits to later years of service, the standard intervenes. The entity is required to attribute benefits on a straight-line basis from the date service first leads to benefits until the date further service leads to no material further benefits. The projected unit credit method forces companies to present value discount their obligations, regardless of how far in the future the final settlement lies. It requires companies to map future salary increases and demographic shifts directly onto the balance sheet today. Measuring the DB obligation requires demographic assumptions like mortality and turnover and financial assumptions like medical cost trends. IAS 19 dictates these assumptions must be both unbiased and mutually compatible. Entities cannot use arbitrary internal targets for discount rates. The rate used to discount post-employment obligations must be determined by reference to market yields on high-quality corporate bonds at the end of the reporting period. To find the actual deficit or surplus, the entity calculates the total obligation and then deducts the fair value of any plan assets held by a legally separate fund designed solely to pay employee benefits. Often, employees or third parties make contributions to the plan. This flowchart maps exactly how those contributions are handled, starting with whether they are set out in the formal terms of the plan or if they are discretionary. Following the logic tree for formal terms, if the contributions are linked to service and the amount is dependent on the number of years of service, they must be attributed to periods. But if they are independent of the number of years, like a fixed percentage of salary, the entity reduces the service cost in the period the related service is rendered. When an entity introduces a plan amendment or a curtailment, it generates a past service cost. This cost is recognized immediately as an expense at the earlier of the amendment date or when related restructuring costs are recognized, demanding a real-time remeasurement of the liability. Defined benefit obligations are sensitive, volatile constructs. Because they are governed by market-pegged assumptions and immediate cost recognition, their financial footprint fluctuates based on variables outside of management's direct control. To manage this volatility, IAS 19 mandates a geographical separation of defined benefit costs across the financial statements, breaking the data into 3 distinct pipelines. Pipeline A carries the service cost, including current service cost, past service cost, and any gains or losses on settlement. This flows directly into the profit or loss statement. Pipeline B carries the net interest on the net defined benefit liability or asset. This is calculated by multiplying the net liability by the discount rate, and it also flows strictly into profit or loss. Pipeline C handles remeasurements. This includes actuarial gains and losses, and the actual return on plan assets, excluding amounts already calculated in net interest. These volatile swings are reported in other comprehensive income. The standard applies a strict constraint to Pipeline C. Remeasurements reported in other comprehensive income can never be reclassified or recycled back into profit or loss in subsequent periods. This geographical isolation protects the operational P&L from unpredictable actuarial volatility, while ensuring that the economic reality of the obligation remains fully quantified on the balance sheet. The disclosure requirements of IAS 19 are detailed, requiring specific quantitative reconciliations for the defined benefit obligation, the plan assets, and the effect of the asset ceiling. Entities must describe any asset-liability matching strategies they use, predict future cash flow contributions, and provide a sensitivity analysis for every significant actuarial assumption, showing exactly how changes in estimates alter the underlying liability. Not all long-term agreements require this level of reporting. Other long-term employee benefits include items like long service leave, sabbaticals, and deferred remuneration, not expected to be settled within 12 months. Because these obligations are less uncertain than lifelong pensions, IAS 19 permits a simplified method of accounting. Unlike defined benefit plans, remeasurements for these other long-term benefits are recognized directly in profit or loss. The standard scales its accounting complexity in direct proportion to the uncertainty and risk a specific benefit type poses to the entity. Termination benefits are treated separately from the rest of the standard. The defining factor is the event that triggers the obligation. A termination benefit is triggered specifically by the termination of employment itself, not by the rendering of employee service. The liability and expense for a termination benefit are recognized at the earlier of two dates: when the entity can no longer withdraw the offer of those benefits, or when it recognizes costs for a restructuring under IAS 37. We can see this distinction in a factory closure scenario. An entity announces a factory will close in 10 months. All 120 employees will be terminated. Employees leaving before the closure receive 10,000 currency units. Employees who stay and work the final 10 months receive 30,000. Every single employee is guaranteed 10,000 currency units because their employment is ending, regardless of future work. That base 10,000 is a true termination benefit. Multiplying that by the 120 staff creates an immediate 1.2 million currency unit liability the moment the plan is announced. The incremental 20,000 offered to the 100 employees who agree to stay is treated differently. That money is provided in exchange for ongoing service over the 10 months. It is not a termination benefit, it is a short-term employee benefit, recognized as the service is rendered. This distinction encapsulates IAS 19's core mechanic, isolating the cost of ending employment from the cost of extracting ongoing economic value. When adopting IAS 19, an entity must apply the standard retrospectively in accordance with IAS 8. This pulls its recognition and measurement rules backward, restating the earliest comparative periods presented in the financial statements. From straightforward short-term sick leave accruals up through the actuarial mathematics of the projected unit credit method, IAS 19 requires continuous reconciliation between human effort and financial reality. The standard strips away the ambiguity of future promises. It replaces undocumented corporate assurances with quantified, present-day financial liabilities, enforcing transparency on the balance sheet for the true cost of a workforce.